Thank you, Mint, for giving me this opportunity. Welcome, everyone. Today, I'll try and talk a little bit about REITs, not just as an investment asset class, but a way for every Indian to own real estate, and India's best real estate, I'd say. And I'll share my perspective on why REIT right hai. Agar mutual fund sahi hai, to REIT bhi right hai. So let me start with a question. How many of us have felt that real estate is just a dream and we always found it out of reach? Show of hands. There are a few. And for those lucky ones who had real estate, how painful is it for the rental income and the tax that you pay on that rental income at your slab rates? Again, very painful? Right. So imagine you are able to own a slice of India's best real estate, whether it's malls, whether it's office buildings, just for rupees 500. Wouldn't that be interesting? And the rent that you earn out of it, that's tax-free as well. Wouldn't that sound very interesting? That's what REITs is all about. It would redefine how you think about real estate investment in India. So introducing REITs to you all, REITs are vehicles that operate income-generating properties. They generate rental income. It's a total return product, as in it gives you rental income, which is then distributed to the unit holders as dividend, and then as the property appreciates, you get growth as well along with it. So it gives you accessibility of a mutual fund with the size, with the unit size being as small as it can be, and it gives stability and growth like real estate would. Structurally, very similar to how mutual funds operate. You've got the REIT being settled by promoters or sponsors. You've got a trustee who acts on behalf of the unit holders. You've got a manager who manages the REIT, and then you've got assets under the REIT. What the manager gets is the fees, and the trustee gets his share as well. What's left out, so these properties generate rentals. What's left out of paying these fees is actually distributed to unit holders. And that distribution actually comes with tax benefits as well. So we'll talk a little bit more on the other slide. It's a relatively young asset class, a decade in the system. I'd say it got introduced in 2014. But the first REIT came up only in 2019. That was Embassy REIT, which was an office REIT. Thereafter, we saw on an average one REIT a year. Mindspace, Brookfield came up with their respective REITs. Nexus came up with the first retail REIT in the country. And thereafter, you've got Knowledge Reality Trust, which is again an office REIT. So today, we've got about 5 REITs listed on the stock exchange, of which 4 are office REITs. And one of them is a retail REIT. A little bit about the global kind of evolution of REITs, right? US actually were the first. India is where US was maybe 50 years ago. US today, every investor there has investment in REITs. And I think it's time right for India to actually have It's the right time for India and the investors here to actually start investing in this product. Again, some global statistics around 98% of the US real estate market is in the form of REITs, whereas India, it's as low as 12%. We're just getting started, and this is the right forum, I would say, with the demographic and the audience that we have, that this is the right start for younger kind of investors to start investing in REITs. See, globally, I would say, obviously, foreign portfolio investors have been investing in REITs in India as well as overseas. But even the Indian institutional investors, be it insurance companies, mutual funds, have actually invested. And I think from where we were in 2019, when the first REIT came in, there were about 6,000 unit holders as retail unit holders. That's gone up to about 3 lakhs today. So we've seen retail participation go up in this asset class, and this asset class is just about starting to kind of see or break through from here on. The 5 REITs that we spoke about totally have a gross asset under management of 2,25,000 crores. They have a market cap of about 1,50,000 plus crores. Like I said, 3 lakh unit holders. They are part of all of the large indices that global institutional investors follow. They have AAA ratings, so it's safe as well. So it's at a cusp of retail revolution, I would say, and with just 12% penetration, it's a space where people start looking at very seriously for investing. If you kind of look at what are the benefits, right? So kind of when you think about real estate investment, it comes with a lot of hassles of managing real estate. And here is a product that helps you pass on that hassles to a professional team. So professional management, we've got liquidity as well. Traditional real estate is not liquid. When you go out to sell your commercial real estate, you won't find buyers. But here, it's a product listed on the exchange, and therefore there is liquidity as well. Corporate governance, and that's when SEBI comes in. So they've kind of helped improve the corporate governance in this product. Regular income generation. So REITs are required to distribute 90% of their profits every 6 months to the unit holders. So no holding back on the profits. 80% of the assets need to be rent generating. So you don't take you don't take too much development risk. You do take some risk to create delta returns, but then 80% is in rent generating properties. And then you have caps around what's the levered ratio, you can't go beyond 49%, et cetera, et cetera. So it's all taken care of by SEBI by creating very robust regulations. And like I said, REITs are a yield plus product, so you get those returns. So the rentals come to the unit holders as distribution, but as the property value increases, as the business grows, the price of the unit on the stock market also grows. So it's a growth product as well. And it helps you diversify. So when you buy real estate as an individual holder, you probably will be confined to one city, max 2 cities. And here is a product that helps you own assets in multiple cities for I think, diversifying risk. This is an interesting one. So investors, REITs have done better than FDs, and we obviously spoke about the certainty that FDs get you. But over a 5-year period, we've seen REITs deliver about 15% total returns, of which about 6.5% has been in the form of dividend or yields, and the balance has been in the form of appreciation. But again, it's a total return product, gives you about 15% yields, which is in the last, I think, year or so, it's performed better than the stock market. But over a longer period of time, it's not done badly yet. A lot of investors do ask us this, saying that why not buy physical real estate? One is obviously the ticket size. You go out to buy a property today, anything less than 1 crore, it's not available in the market, right? But here is a product that's available as low as 500 rupees. Right? So it's easier to buy. There is liquidity on the stock exchange, whereas when you kind of go to sell a real estate property, you don't really get that liquidity. There's diversification, like I spoke about. You don't are not concentrated on a particular city or a particular state. Here is diversification that's possible. Professionals run REITs, and it's left to them to generate returns. Governance, we spoke about, whereas real estate, we all know it's kind of how it's being governed state by state. And I think the important point around taxability, right? It's largely the distributions that come from REITs are tax-free, and I'll get into it on the next slide. But keep this in mind, it's largely a tax-free product compared to whatever rental income you earn on your other real estate properties. This is the taxation. I think the taxation at the REIT level is pretty much exempt throughout. These are the 3 components of income that typically REITs generate. They give out dividend, they give out interest on the loans that they've taken from the trust, and they kind of repay the loan. All of that is exempt. Even capital gains that the REIT generates on sale of some of its shares of units or units of its SPVs there's no capital gains there because it's a pass-through entity. For unit holders, I think the important piece is the dividend piece, which is actually exempt. Interest is taxable. typically about 1/3 is the interest component, which is taxable at the maximum marginal rate, but 2/3, which comes in the form of dividend or amortization of SPV debt, is actually not taxable. So that's the benefit. And when you kind of sell those units on the exchange, you earn, you pay capital gains tax like you would pay for any other equity share. So it's at par with equities. Tailwinds on this thing, I think we've seen a lot of domestic participation here, institutional participation. Like I said, retail participation is going up. It's being recently classified as equity by SEBI for the purposes of indice inclusion. So a lot of domestic indices will start kind of actually replicating or following or having REITs in the nifty indices. And I think there's growth potential. So just considering the real estate market in India, from a retail standpoint, there's a 6x opportunity growth in terms of how much property can actually come under a REIT structure. And that's about 2.5x for office because the base is much larger. And then you'll see a lot of other sectors which will see REITs. So you'll see REITs in healthcare, data centers, you'll see them in industrials, so on and so forth.
Hello, check. Have we got any questions for Mr. Pratik Dantara? Yes, sir. You stood up first.
The property, it is about owning a part of the property. Presently, yes, you said it is regulated by SEBI and all that, but what is a confirmation I get that I'm a part owner of the property? For in Dubai, I'm an investor in REIT in Dubai, and I do get a Dubai municipality certificate that I'm a 0.5% investor in that property, and the property has been split into that around all that. So here, if I invest in India, what is the certification I get? I understand it is maintained on the blockchain, I understand all the technicality stuff, but I'm still an official partner owner. For example, if I own a site in Bangalore, I have dash, 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 which clearly gives me a title. So how does it work in the REIT process?
So here, it's a trust which owns the properties under it, whether it's through SPVs or directly. And the way it works is you will get the units of the trust in your demat account. So you will get that statement, which would mean that you're kind of an owner or a part owner of the properties that the trust owns.
Okay, any other question?
Are real estate, are REIT going to be allowed to invest in single-family homes?
We have to see. We're working with SEBI on some of those fronts, but again, from this point, from where we are today, single home funds are not allowed.
Not allowed.
Under the
And SEBI may allow it.
They may, but we will obviously have to have SEBI's blessing on it.
Okay.
We will take one last question from you. Yes, in yellow.
Hi, sir. Karan here. So just a question that as the REITs are in their young stage in India, and the real estate market is expected to grow at around $1 trillion by the year 2030. So from a REIT's perspective, what is currently the allocation of the REIT in terms of the greenfield investments and the brownfield investments? And as managers, do you guys actually think about the environmental perspective also of the growing REITs and real estate markets?
So as per regulations, REITs are required to have 80% of the value of the properties in rent-generating properties. The balance 20% can actually be under construction, and therefore you're allowed to take that much amount of risk. But again, because it's a product which is yield plus, you'll always have 80% which is actually rent-generating.